Lemonade gave a full year 2023 adjusted EBITDA guidance of a negative $245 to negative $240 million loss, which was surprising for investors because they talked about peak losses coming in Q3 or Q4 of last year. And in Q4 of last year, they had a $51.7 million adjusted EBITDA loss. You'd think for 2023, if these are around the peak losses, you'd be close to that $200 million mark in adjusted EBITDA losses for the full year or better. But 245 to 240 was quite alarming for investors. But from the earnings call, we got a nice nugget from Tim Bixby where he said, even from an annual perspective, our aspiration and goal is that we'll see last year's peak losses, which were around $225 million. Our guidance reflects some conservatism in that. Tweeted this the other day or a few weeks ago, said, sounds like Lemonade's management is sandbagging with their 2023 full year guidance. Guided 245 to 240, but said in the call they hope last year's negative 225 was peak losses on an annual basis. And Daniel actually replied to this tweet. He said both adjusted EBITDA and growth are highly sensitive to loss ratio, which in inflationary times is highly sensitive to regulatory approval cycles, as we can't predict either inflation or regulatory approval. 2023 is a tricky year to guide to. As we have indicated, if our rates are approved fully and timely, we'll be able to grow faster and more profitably. That's our hope and ambition this time. Last year, we guided to adjusted EBITDA of $275 to $290 million, excluding Metro Mile, and managed to deliver $225 million, including Metro Mile. So a massive beat. But our guidance is conservative in that it doesn't bank on this happening. That's not so much sandbagging as protecting the business from macro factors we don't control. But as Tim said, our aspiration and goal is that 2022 will be peak losses from an annual perspective too. That's very helpful. Thanks, Daniel. And to be totally clear here, I meant no disrespect with the term sandbagging in the original tweet. And I don't actually think they're purposely trying to put out guidance so that they can go and crush it, but I do think they're going to crush it. So let's have a look at my Lemonade model. This is available to my Patreon supporters if you want to join my Patreon. But I have two tabs at the bottom here, guidance 2023, and then also a current model. First of all, let's look at the guidance tab, two copies of the same model. In this tab, I'm going to try and shoot for what they are guiding to. Try and input the numbers so we get close to what the guidance is saying, that $245 to $240 million loss. And their guidance for the end of 2023 was only about $700 million in force premium, so a relatively small rise year over year, maybe 12-13% from where they were ended last year at. And I'm assuming overall a sort of a bit of premium per customer growth, but a bit more also customer growth, because they've talked about in some of their calls that renters insurers is their most profitable product line, their oldest product line. My guess is they're going to be going more into renters, targeting renters as new customers. And so you'll still see some growth there, but then in their existing customer base, more people sign up for more products. So you'll have some slow trickle improvement of premium per customer. That's what I'm assuming there. And again, I'm trying to get close, trying to be more pessimistic than I really would be to get close to what they're guiding for. But you're going to see through these numbers that I don't think their guidance is realistic. I think it's more realistic. Their guidance is maybe possible, but I think it's much more realistic. They're going to beat the guidance and maybe even crush the guidance. So I've put it here 89% gross loss ratio, which is where they ended Q4 at. So I put that for the whole year, just basically assuming there's no improvement in gross loss ratio over the year. My annual dollar retention, which is a function of how premium per customer is rising, but also the churn of the customers. So it has been rising. It was at 84%, 86%. I think it's going to continue to rise probably early this year, or at least I'm even in this guidance model, I'm assuming that, and then have a taper off, sort of negative effect later on in the year and into next year as we push more into renters. Those kind of policy holders who are just getting a renter's policy are more likely to churn as well. So it's also going to have more annual dollar retention, or worse annual dollar retention. And you can see this, I actually model this into the future based on the churn from 12 months prior, which has been steadily improving 28% to 23%. And then I have it 23%, and then just jumping up later in the year. And again, of course, down the road, it's going to go back down. I think eventually probably hitting more like 15% in the long term as you have all products everywhere. I have sales and marketing as a percentage of gross earned premium coming down quite a bit. I basically, my sales and marketing expense is a function of new customers. I've been saying about $200 per new customer they're acquiring, but the amount of customers they are acquiring is smaller because their growth they've really put on hold. So I expect sales and marketing to really come down from where it has been as a percentage of gross earned premium. I mean, overall, it is slowly trending down, but last quarter was 18%, and I'm expecting 18% as a percentage of gross earned premium. Other insurance operating expenses I've kept similarly as a percentage of gross earned premium, whether it's other insurance, whether it's tech development, have basically flat, other with a small increase. General administrative still have increasing 8% quarter over quarter. So it's actually even rising later in this year, which again, I'm trying to be pessimistic in this tab, in this guidance tab that I'm showing you right now, to get an overall expense ratio, expenses relative to gross earned premium of about 60, or say in the 60% range. And in Q4, for reference, it was 63%. So in that 60% range, even if it sticks around and hangs in there, and I also assume stock-based compensation of about $60 million for the year, get adjusted EBITDA of approximately $225 million. The sum of these four cells, $225 million for the whole year. So I think these numbers that I just showed you here are fairly pessimistic, and you still get basically on par with what they did last year. So it's hard for me to go back to their guidance, 240 to 245 to 240. I don't think they're going to actually be in that guidance. And I certainly don't think they're going to do worse than that guidance. That would be quite alarming. But I think even this model that I just showed you, what I'm trying to be is pessimistic, but still somewhat realistic as I could be. I still am only at 225 million. So I don't think they're actually going to fall within that guidance. What I'm trying to tell you in this video is, again, not financial advice, but I think they're going to beat the guidance. Now, how much might they beat it by? Let's look at the current model, my actual model, to look at what I think might be possible. In this model, I have a little bit more premium per customer growth, growing to $375 premium per customer. And my previous one I just showed you had $367. So slightly better premium per customer, assuming more of the existing customer base buys more products. There's a little bit more bundling. And then even a little bit less customer growth. And then relative to that, your in-force premium, slight beat on their guidance of $700 million. I have $713 million of in-force premium. Gross loss ratio I have was 89% in Q4, and slowly coming down 86%, 84%, 82%, 82%. Obviously, this really could be affected negatively if there's more catastrophes, or more positively if there's less catastrophes. But I'm trying to, again, also assume there's some positive growth in this direction as this number comes down, as they weed out poor customers, but also they have rate changes begin to get approved and more new customers come in, or customers renew at slightly higher rate changes, and you have slightly better overall loss ratio. Similar to the last model, when you're looking at annual dollar retention, I have a little bit higher and then going lower, and then eventually it would go higher. And if you're looking at it from a churn perspective, 12 months prior, I have it at still 23%, which was Q4 for the whole year, before then rising a little bit as more renters sort of push it up temporarily, and then again it would go back down in the years following. I also have the customer acquisition cost slightly better at 190. The overall average has been about 180, I think it's 187 or 189, something like that is what my math works out to. So this is 200, might have been a little bit more pessimistic again in the last model, but I have $190 per customer, especially if they're targeting more renters this year as the new customers. I think that's more accurate, because you're competing against renters, that number should be lower than if you're competing for customers that are buying bigger ticket items. And your expenses as a percentage of GEP, again, sales is 18%. I have it lower this year, which makes sense because they have much less growth. Other insurance expense, again, still rising, but still about 9% of GEP. Tech development, again, I have at 0% overall. Overall spend is, I still have, $23.5 million, $94 million for the year. Last year, tech development, they spent $79 million. So still an increase overall, but not a quarter-over-quarter increase. So the point I'm trying to make is that I don't think any of these numbers are unreasonable. Again, G&A, I have rising about 3% a quarter, so coming down, sustained about 21% as a percent of GEP across the board, which is what it was in Q4. And then your total expense ratio going from 63% down into the high 50s, 58, 57%. You put in all those numbers, the math all works out. $60 million stock-based compensation. Adjusted EBITDA is now at about $170 $36 million. I think this is very possible. They guided 240 to 245 loss, and they maybe actually do like 175, which would be a pretty substantial beat. So what does this mean for the stock price? Well, I don't know exactly. I don't have a crystal ball, but I'll give you some thought. And macro could have a huge effect on it, positively or negatively. So keep that in mind, but at least here are a few of my thoughts. If the market is pricing them as though they'll likely fail and go bankrupt, then I think they'll be valued similarly to their cash balance or worse, which is how they've been valued at for some time, or roughly how they've been valued at for some time. So if they have, they're about a $900 million market cap right now, and they have, about $1 billion in the bank, so about $100 million less than their balance. So, but if they drop by say 200 million or 175 million and down to say 800 million, 825 million in cash on hand, they could easily go from a market cap of say this $900 million range to the $700 million range, or maybe even less. Should be about a 20% lower than where they're at right now. So if we're at $12, $13 a share, maybe we're at 10 something a share by the end of the year, if that were to happen. And if the market's evaluating them as if this is a company that's not going to make it, which I think is more sort of the sentiment and thought right now. And whether the market thinks they'll go bankrupt or not, I think really depends on how much they beat their guidance, this guidance by. Is it negative 175 million, or is it a 225 million beat, as I showed you in the first 225 sort of scenario there? I think if they only beat partially and do like a $225 million beat, or even, if they do worse than that, I think we'll be in that like 20% or less sort of trim off the stock price from where we are right now. I think, if I had to speculate, if they significantly beat and they do like, 175 million, like I am modeling, I think is more probable. I think the market will be happy because that's a massive beat. It's a massive turnaround from last year doing negative 225, this year doing say 175. The market might see that as a more positive sign that they did see peak losses and they are having a turnaround towards profitability. So what is my plan? Well, I am really quite the simpleton when it comes to trying to evaluate macro market conditions. I really try and evaluate and focus on the company itself and whether I think I have that right, rather than sort of the overall up or down buying opportunity of the greater market. At least that's my own philosophy with investing. So I've been slowly buying shares throughout. And to be clear, I'm not making huge purchases relative to my portfolio, but I continue to slowly add shares when I can. It's really tiny amount compared to the overall portfolio, but I am slowly trickling in and adding shares. And I myself, I've never gone, all in on Lemonade. I know my channel is focused on Lemonade, and I think it's an interesting company because the possible upside is just enormous. But in order for me to really go all in or really push my portfolio into Lemonade significantly, I would have to be supremely confident in their success and upside. I mean, supremely confident. Just as I was like a number of years ago, I felt supremely confident in the success of Tesla long term. I would have to feel that supremely confident in Lemonade to do a similar move. And I do feel that this could happen, that the supreme confidence of success and huge upside could be there, but even if that did happen, I think the company would still be misunderstood for a long time, which might mean the share price is still rising, but not rising as much as it should be, which could mean in that scenario, say, whereas maybe I gain the supreme confidence in the next 1-2 years that they will be successful and do have this huge upside, I still think there would be potentially years to accumulate shares at attractive pricing, just because the company, I think, and the overall opportunity could be misunderstood for a long time. So to be clear, it hasn't happened yet. I'm not sort of an all-in position in Lemonade, but I think it's a possible scenario that plays out. I just saw this clip resurface again about Amazon versus Sears from back in the day. And I want to just roll it because it connects to Lemonade, I think, and where we're at right now.
How do you view that phenomenon that Amazon today is worth more than Sears?
Investors are focused on the future. Amazon has growth potential that Sears doesn't.
A couple of geeks who sketched out some software could destroy Sears Roebuck.
That's the beauty of technology and the microprocessor. We've never seen anything like it.
I love how this correlates to Lemonade's story. Amazon back in the day, it's building its infrastructure, it's building its systems, it's getting new customers, it's getting the trust of customers, and they're bleeding cash back in the day, and the company is deeply misunderstood by analysis, by reporters, by the public at large. But the wisest analysts back then, had looked carefully into the future and saw this vision, this potential vision of Amazon. They saw a much more ideal shopping experience for the customer, and they saw how technology could enable it. And that's where those smart investors back in the day were seeing this company, which again, after this interview, had a massive decline in stock price, was deeply misunderstood for a long time. Even when the seeds of success were all being sown, or on the fruits were all starting to present themselves, and there was massive opportunity to buy Amazon stock for a long time. I think if Lemonade's successful, we're going to have an opportunity like that for a long time, and we'll have a lot of fun on this channel talking about all the shares I'm buying if that were to occur. So that's my long-term strategy. I don't know if I've ever really laid that out for you guys on this channel, but that's my long-term buying strategy for Lemonade stock if they are successful. It's contingent on if they execute well and if they are successful. But I still feel that they will be. My thesis is still that they will be, but time will tell. Thank you so much for watching. Let me know in the comments down below what you thought of this video, and remember, it's in the bag.